What's up, money lovers? Welcome back. So I've officially started a new position today in the portfolio. This is a stock that I've been talking about for a while, made a video on it, and it's actually an index fund. It is called VYM, and it's Vanguard's High Dividend Yield ETF. So I'm going to talk a little bit about why I'm getting into this and why now. So while, I've been talking a lot about innovative companies, growth plays, that's where the majority of my portfolio sits. If I were just starting investing today, I wouldn't be buying VYM. I would be putting all my money into these, highest growth avenues or the total market index fund or a combination, because in the long run, I think that they will do the best. They have the best prospects. But because I already am so, over exposed to the technology sector and a lot of these very high growth plays, that much of it is a little bit on the more speculative side, I want to just get myself further diversified. I really, going into 2022, wasn't ready for a bear market, and I've really seen that first couple months here. I mean, my portfolio has gone destroyed. I'm down over 10%. I'm still up a ton, obviously. I made almost a 300% cumulative return in 2020 and 2021, but I am down about 10%, a little bit more maybe to start the year here in 2022. And it's because I didn't do enough to hedge myself. I wasn't protected enough. I've got a small position in cash, maybe like 3 to 5% of my total portfolio, which even that is lower than I would like it to be, especially when, I'm also looking at possibly putting a down payment on a house soon. So I want to be somewhat liquid. I want my money diversified and have a good amount in a preservation mode. So that's where VYM comes in. If we just take a look at the fund here real quick, obviously I did a deep dive on this. I'll just do a quick summary. The top 10 holdings, these are all great companies that I've talked about. J&J, Home Depot, I just made a video on. But more importantly, when we're looking at inflation, when we're looking at rate hikes, JP Morgan is the second biggest holding. Bank of America, the fifth biggest holding. You get some oil exposure. Oil prices are going through the roof. And you get a lot of healthcare exposure as well here. AbbVie, Pfizer, J&J, obviously. The best assets to be in, obviously, real estate's good too. But, stock-wise, financials, when there's inflation and interest rate hikes, financials will perform the best. Banks are making more money. Healthcare will do fine. And if we look at, the holdings here, 21% is in financials, 12% is in healthcare. There's only 7.7% in technology, which this was a key for me too, because like I said, the majority of my portfolio is already in technology. I'm overexposed to technology, and I am still bullish in the long run. These tech plays will be my best performing stocks when we get to 2030, but just short term, to put some stability in the portfolio, I wanted to add VYM, and I also want to trim down my portfolio. So I don't want to start adding new positions here, because I could have added JP Morgan. I could have added Home Depot. I like these companies, especially Home Depot. I own Johnson & Johnson, and there's a lot of good companies in this top 10 and the rest of the portfolio as well here, and the rest of VYM as well. But the way I see it, for simplicity, less for me to keep track of so that I can really focus on my high conviction plays, because at the end of the day, I can't keep track of 30 stocks every day, everything that's happening with them, It's just not the reality, unfortunately. And even still, even if I could, if you're owning 30 plus stocks, I just feel like it gets to a point, might as well just own an index fund, right? So this way I can focus on my high conviction plays, get some stability, and I'm hoping that VYM, will kind of, if we do have a flat year here, between the dividend and hopefully a little bit of price appreciation, if a lot of my other investments do tend to be flat this year or keep going down, then I could kind of rely on VYM to give me a cushion and give me some green here this year. If we take a quick look at the chart of VYM year to date, it's only down 3%, which is much less than if we compare that to the broader market. SPY year to date is down 11%, and tech stocks even worse. If we look at QQQ, are down almost 20%, which is insane. But like we said, so this is where I have a lot of exposure in things like Tesla. These stocks are down quite a bit from their all-time highs. Again, still up a lot, obviously, in the grand scheme of things. And in the past year, VYM is up 10%, and then you add in the dividend yield, which is actually going up because the stock's going down here, 2.75%. So that gives you, let's just say, obviously, I don't know what it's going to do in the next year. I don't have a crystal ball, but maybe I can get a 12% return if it goes up another 10% and plus the dividend. So that's what I'm looking to do here. Now, again, if I was just starting out investing and I really didn't have much holdings, I would not be buying this. Okay, I would be buying the total market index or the S&P 500, and I'd be buying some high conviction plays. If I was starting it all over again, I'm talking the Teslas, maybe Nvidia, stuff like that I think is poised for growth in the next 10 years, because I would just be trying to grow my money as much as I could, and that's still my goal. I'm still young, but again, I just want to be smart. I want to diversify a little bit away from tech, the high volatility, because that's the thing is, tech goes up 20%, goes down just as fast, if not faster, 30%. It's very volatile, especially in this current environment we find ourselves in. So I want to add these stable companies. And I mean, you look at the top 10 holdings here. Yeah, there's other dividend ETFs, like people like SCHD. I've covered that one on the channel. There's VIG as well. But again, those give you more tech exposure. I really like how small the tech exposure is in VYM, just from my own personal situation. And we look at the top 10 holdings here. I mean, this is like a dream team lineup of stability. That's the way I look at this. J&J, JP Morgan, Home Depot, Procter & Gamble, Bank of America, Exxon, Pfizer, Chevron, AbbVie, Pepsi. That's like the apocalypse stocks right there. Like, you cover your bases here. You get some consumer staples. Like if the economy tanks, Pepsi will do fine. All of these companies will do fine in a bear market, is the way I see it. They could still go down, but they're not going to go down as much as big tech, as more speculative stocks. So let me know what you guys think. Do you agree? Why not? In the comments below. If you enjoyed the video, please don't forget to like and subscribe. And this is Vinny from the Investment Club. I'll see you next time.